Hello students, so now this is day 2 of the financial reporting revision session for September 23 exam. And today we are going to discuss the group accounting aspects, that is consolidated financial statement. So we have to discuss two things. One is the consolidated statement of financial position, SOFP, and another one is consolidated statement of comprehensive income statement. So let's discuss first how to prepare a consolidated statement of financial position. Before moving to the statement of financial position, let me tell you that in order to prepare a consolidated SOFP, we have to follow these steps. Step number 1, identify what is the group structure. What is the percentage in subsidiary? Is there any associate? So we need to identify what is the percentage of NCI, that is called group structure. The next thing is we need to calculate cost of investment by parent company. Next is identify fair value of NCI. It might be given to you in the question, and if not, you have to calculate. Then the most important thing is fair value of net asset of subsidiary, including the fair value adjustments. And the next one will be find out goodwill at acquisition. Then identify all adjustments given in the question, such as the intragroup trading in goods, the intragroup receivables and payables, other adjustments, and then consolidated retained earning and NCI, the group's retained earning and NCI at reporting date. And finally, if there is no associate given, then we will compile the consolidated SOFP. Then we'll combine the balance sheet of parent company as well as the subsidiary company. So we'll follow all these steps into this given question. So the requirement of the question is prepare the consolidated SOFP for Runner Co. as at 31st March 20X5. Now let's see the question. 31st March 20X5. This is the year end. So 1st April 20X4, that is the beginning of the year, Runner Co., which is a parent company, acquired 80% shares of Joggers Co., which is a subsidiary, when the retained earnings of Joggers Co. was 19.5 million. This is retained earning at acquisition, 19.5 million. Parent's percentage is 80%. So NCI is 20%. This is step number 1, that we have 80% shares and the remaining 20% being held by NCI. Now, consideration comprises of cash of 42.5 paid immediately. This is the immediate payment. And a further cash payment of 21 million. This is deferred until 1st April 20X5. That is after 1 year. So whenever there is a deferred consideration, we need to calculate the PV of deferred consideration. And then we have to consider the time value of money, the unwinding of discount as well. No accounting entries have been made in respect of the deferred payment. That means cash payment of 42.5 million is already recorded. So we need to pass the entry related to deferred consideration, and we need to find out the present value. For present value calculation, cost of capital is 8% and the discount factor is 0.926. So what I have to do? I have to identify the present value of this. So let's calculate the present value of this, first of all. And that is 21 million multiplied by 0.926. So this is the present value of deferred consideration. Now let's identify how much is the value. Let me calculate. So it's 21,000. It's 21,000 multiplied by 0.926. It's 19,446. So we round off, if we round off this, it's 19,500. It's 19,500. So it's 19,400 and something. So we'll take 19,500, or we can take the whole value. Now let's move forward. 19,446. Take the whole value. 19,446. So that means my total investment is cash 42,500 and 19,446. The draft balance sheet of the two companies is given. Now see, the investment is already recorded 55,000. That means out of this 55,000, 42,500 is already recorded in terms of cash consideration. So the leftover is 42,500 is already recorded. So out of 55,000, let me calculate what is the remaining value. 55,000 minus 42,500. It's 12,500. What is this 12,500? We have to see. Then we have inventory, receivables, bank balance, equity shares of parent company and equity share capital of subsidiary company, retained earning at the reporting date. We have payables. Now see, point number 1. Runner's course policy is to value NCI at fair value. That is full goodwill method. And the fair value of NCI is given in the question, that is 13 million. So let's find out goodwill. First of all, we have to find out cost of investment. So first of all, it's cash consideration, which is given in the question, 42,500. Add the present value of deferred consideration, and this is 19,446. So total investment is 61,946. Then it's fair value of NCI given in the question, that is 13,000. So it's 6, 4, 9, 4, and 7. Now we need to identify fair value of net asset of subsidiary at acquisition. Important working we need to do. So let's calculate fair value of net asset first. So point number 2, the fair value of net assets, the fair value of Jogger's other assets, liabilities and contingent liabilities at 1st April 2004 were equal to their carrying amount with the exception of a plant having a fair value of 10 million in excess of carrying amount. This is fair value uplift. The plant had a 10 years remaining life. So we need to find out depreciation. So it's 10 million divided by 10. So it's 1,000 depreciation that we need to adjust. Now let's calculate fair value of net assets. We will use 2-column approach. Net assets at acquisition at reporting date And we need to find out the post-acquisition profit, share capital of subsidiary company, retained earning, as well as the fair value adjustment. Let's find out what is the share capital. Share capital is 25,000. Retained earning at acquisition is 19.5 million. So share capital, there is no change, 25,000. Retained earning at acquisition, it's 19,500, 28,600. Fair value adjustment at acquisition, 10,000. Net of depreciation, 1,000. So that is 10,000 minus 1,000 is depreciation. And we have at acquisition and at reporting date. So at acquisition, it is 54,500. And at reporting date, this is going to be 25 plus 28,600 plus 9,000. It's 62,600. So it's 62,600. And this is the post-acquisition profit. 62,600 minus 54,500. It's 8,100. We'll use this figure in consolidated retained earning and NCI. So now let's put this here. Acquisition 54,500. So it's 54,500. And this is what is the goodwill at acquisition. And this is 20446. This is to be reported in SOFP as an intangible asset. Now, the next adjustment is the intra-group trading. In December 20X4, Jogger Co. sold goods to Runner Co. for 6.4 million. This is the sales value. Jogger Co. is a subsidiary, so it's between subsidiary to parent company. Earning a gross margin of 15% on sales. So sales is 6,400 and margin is 15%. Runner Co. still held 4.8 million of these goods in the stock. So PURP. So we need to calculate PURP, that is 4,800 into 15%. We can apply directly 15% because it is given the margin. So it's 720. So PURP is 720. And the seller is a subsidiary. So the effect of PURP, you can see here, consolidated retained earning debit, NCI debit, and stock is credit. The effect is in CRE as well as NCI up to 80%. So goes to parent company, that is 576. And the remaining 20%, 144, we have to deduct from NCI. Next adjustment, Joggers Co. still had the full invoice value of 6.4 million in its receivable. This is against the intra-group trading value, that is 6.4 million, the same. This is 6.4 million sales and full invoice value is in there in the receivable. The Runner's course payable only shows 3.4 million. So this is the intra-group balances difference. And the difference, 3 million, is not recorded by Jogger's Co. So that means this is called cash in transit value. 3,000 is, this 3,000 difference is cash in transit. So what we need to do, we have to eliminate this whole. So that means record cash in transit 3,000. Eliminate the payable, that is 3,400. Eliminate the receivable, that is 6,400. This is the adjustment. All done. All the adjustments we have covered. Now we need to prepare a consolidated SOFP. So we'll combine all the assets, liabilities, goodwill all together. But before moving on to this, we need to calculate two important figures. One is consolidated retained earning, and other one is consolidated NCI. So let's take parents' retained earning first of all. So it's runners co balance sheet date retained earning, which is given in the question. This one. Then post profit of subsidiary, which is already there in the net assets column. So we have 8,100 net assets, and 8,100, 80% shares belongs to the parent company. So it's 8,100. It's 8,100 into 0.8. It's 6,480. Now we need to adjust few things. PURP belongs to parent company, and that is PURP is CRE 576 debit. So it's 576 debit. Then is there any other adjustment? So we have one adjustment, that is unwinding of discount against the present value we have calculated of the deferred consideration. Now see what we need to pay. The total value at the end of the year is 21 million. And we have recorded the present value 21. We have recorded the present value 19446. So the difference is 1 year unwinding of discount. So this is my consolidated retained earning figure. Next is NCI. Whenever we have to prepare a balance sheet, the best thing is first you create the pro forma of the balance sheet, as I told you in the single company financial statement question, and then insert the relevant figures gradually. So for NCI, NCI at acquisition is given in the goodwill calculation. You can check this, 1,300. Take share in post profit. That is 8,100 multiplied by 20%. So it's 8,100 into 0.2. So it's 1,620. We have to add this and then deduct one adjustment, that is PURP. See, where is PURP? It's NCI debit by 144. It's NCI debit by 144. So what is the value? 1,300 plus 1,620 minus 144. It's 2,776. This is NCI. It's 13,000. So let me calculate it again. 13,000 plus 1,620 minus 144. So it's 14476 to be shown in balance sheet. Now, let's prepare consolidated SOFP. So first of all, we have property, plant, and equipment. That is non-current assets, parent plus subsidiary. So what is the value of parent company's property, plant and equipment? It's, we have to combine these two figures and then adjust the fair value adjustment, net of depreciation. Remember, 455,800 plus 44,700 plus the fair value adjustment, net of depreciation. So accordingly, it's, this is the value. Then we have to show investment. Investment, the parent company's investment, we will not consider this investment. Rather, we will take the difference in value, that is 12,500. Investment in other companies, that is 12,500. Now, after this, put goodwill working. So we have goodwill 20446. Goodwill is 20446. And this is my non-current assets, 446. Now then we have current assets. And in current assets, we have stock, we have receivables, and we have bank balance. Inventory given in the books of parent company and subsidiary company, take this 22,000 plus 16,000. We have a PURP adjustment, 37280. Receivables in the parent company, 35,300. In the subsidiary company, it's 9,000. And then we have credited receivables. Let's see what was that. Account receivable credit by 6,400. So it's 6,400. And bank balance given, parent company plus subsidiary plus cash in transit, that is 3,000. So accordingly, it's 37,900 and it's 7,300. So this is total asset. And it is 624,926. This is the total assets. Now, next one is equity and liabilities. So we have equity shares. Always disclose the parent company's equity shares. This is given in the question. Now, the consolidated retained earning working. We have already calculated this. Consolidated retained earning, 290,950. 290,950. This is the parent's shares of equity. Then add NCI in. It's 14476. And this is total equity, 507,926. This is my total equity. Now, after this, we have to show the liabilities. There is only one liability, that is deferred consideration. And we have to show this in current liability, as we have to pay within 1 year, and that is 21,000. So final value is, okay, there is one more item in there, that is current liability given, that is trade payables. That is trade payables. See how many trade payables are there. So this plus this minus intra-group adjustment, and payables was 4.8 million. So we have to adjust 4.8 million. Wait 1 minute. It was 3.4 million rather than 4.8 million. It was 3,400. So the consolidated payable here I have to show is 81,800 parents companies. Subsidiary is this one. Intra-group is 3,400. So it's 96,000. And now it's 624,926. That is equity and liabilities. This is the value, and our asset side is 624,926, and our equity and liability side is also 624,926. So balance sheet is tied, and all the questions information we have calculated correctly. Next part is Runners Co's acquired another acquisition. 30% equity shares of Walker Co. on 1st April 20X5 for 13 million. Walker's Co. had been performed poorly over the last few years, and Runner Co. hoped its influence over the company would help to turn the company around. In the year ended March 20X6, made a loss of 30 million. Runner Co. has no contractual obligation to make good the losses related to Walker Co. Means he has no commitment to make good the loss. Now, 30% shares means it's an associate company, has significant influence. So it means we have to record this as an associate company, and equity method of accounting is to be used under IAS 28. And we have to calculate cost of investment in associate. Explain how Walker Co. should be accounted for in the consolidated financial position of Runner Co. Your answer should also include a calculation of the carrying amount of investment, which is investment in associate. So let's find out what is the investment in associate first. So this is my original investment, 13 million. This is share in loss. So loss is 30 million. My share is 30%, although I have no commitment, but the equity method of accounting says deduct the loss. Loss is deducted. So my investment left is 4,000. So the theoretical version is that when you acquire an associate, initially it is to be recognized at cost, and subsequently at each reporting date, we have to calculate investment in associate, and we have to show profit or loss from associate in the consolidated financial statement. And at year end, we have to assess its impairment. And if there is any impairment, then we have to account for that impairment as well. So this is theoretical topic of IAS 28. Now let's discuss the next issue. In this question, we'll consider consolidated profit and loss, as well as some goodwill working here. Whenever you have to prepare a consolidated profit and loss, always be careful about the mid-year acquisition effect. So let's discuss the question. On 1st January, year end is 30th September. See, it's clearly a mid-year acquisition. So from January to September, it means we have 9 months. So we'll take 9 months of every figure, not the whole. Every figure is 9 by 12. Gold Co. acquired 90% shares. 90% shares. So that means my NCI is 10%. And for 90%, the Goldco acquired 90% of the 16 million ordinary shares. Ordinary shares given in the subsidiary is, this is subsidiary's share capital, 16 million, par value is 1, so total value is 16 million. How the payment was made? Goldco issued 3 new shares in exchange for every 5 shares acquired in silver. So it's basically 3 for 5. 3 for every 5. Additionally, Goldco pay further consideration on 31st December 20x2 after 9 months of 2.42 per share. This is the deferred one, and cost of capital is 10% and discount factor for 1 year is 0.909. At the date of acquisition, the shares in Goldco and Silverco had fair value of 8 and 5.3 respectively. Okay, further information. It is the policy of Goldco to value NCI at fair value. For this purpose, share price of subsidiary is to be used. That means we have to calculate fair value of NCI as well. In the previous question, it was given. Now, first of all, let's identify cost of investment. So we have two components here. One is the share exchange and other is the deferred consideration. Now, for share exchange, what I need to do, I have to identify how much shares were acquired by the parent company. So its acquisition is 16,000 multiplied by 0.9. So that means the number of shares acquired by a subsidiary is 14,400. This is the number of shares acquired. 14,400, and for every 5, we have issued 3. Now, parent company's share price given in the question is 8. So, issuance of shares by parent company and price is 8. So, this is basically share exchange value, and that is 69,120. Now, the next one is deferred consideration, and we have to pay 2.42 per acquired shares. So it's 2.42 per acquired shares. And how many shares we have acquired? We have acquired 14,400 shares. Discount factor is, we need to find out the PV of that. So discount factor is 0.909. So 2.42 into 14,400 multiplied by 0.909 is 31678. 678. So this is the total cost of investment. It's 100, 800. This is the cost of investment. Now we need to find out fair value of NCI at acquisition, and for which the number of shares of subsidiary total 16,000, 10% held by NCI, multiply by the share price of subsidiary 3.50. So as a result, this is 5600. Now we have to identify net assets. So in order to calculate net asset, at 1st October, the retained earning of silver was 56 million, retained earning at acquisition at 1st October. Now we have acquired on 1st January. So I have to add October, November, December. 3 months profit of subsidiary, after tax profit of subsidiary into this. And see, this is the profit after tax of subsidiary. So take 3 by 12. We'll get this figure, 3 by 12. And this is 2480. This is retained earning at acquisition. At the date of acquisition, the fair value were equal to their carrying amount with the exception of two items. First one is a plant having a fair value of 2.6 million above carrying amount. The remaining life of the plant was 3 years. Depreciation is charged in cost of sales. The second one is a contingent liability having a fair value of 8,50,000, and this has not changed as at 30th September. 850 contingent liability. Silver has not incorporated these above fair values into the financial statement. So let's calculate net assets first. Net assets at acquisition. So we have share capital, and that is 16,000. We have retained earnings. Retained earnings at 1st October. This is 56,000. 3 months profit after tax. And that is, we have already calculated above 2480. We have FVA, and that is related with a plant fair value adjustment 2600 and a contingent liability. So as it is a liability, so it's a negative figure, and this is 850. So this is my net asset figure, that is 76,230. This is my net asset at acquisition. So cost of investment, add fair value, deduct fair value of net asset at acquisition, that is 76,230. And we have goodwill at acquisition, which is 30,170. This is goodwill at acquisition. So my first requirement, I have done with my first requirement, goodwill at acquisition. Now, second requirement is prepare profit and loss account for the year ended, and it's a 9-month subsidiary. Now, for profit and loss account, see other adjustments. One is unwinding of discount, other adjustment. Let's see. Adjustment number 4. Sales from gold to silver in the post-acquisition period has consistently been 600,000 per month. So we need to find out the intra-group sales adjustment. Markup given is 25% on these sales. Silverco had 1.2 million of these goods in stock. First of all, the sales value, 600,000 per month. So we have 9. So it's the intra-group sales is 5.4 million. Unrealized profit, PURP, markup is 25. 1.2 million of sales is in stock. So it's 1.2. Markup is 125. So sales value is 125. Multiply by 25. And as a result, we have, let's calculate, 1200 divided by 125 multiply by 25, it's 240. So unrealized profit is 240. Next adjustment. Gold shows investment income is the dividend received from its investment in a 40% owned associate, which it has held for several years. The associates made a profit of 3 million this year. So we need to find out share of profit from associate, and it's clearly 40%, that is 120 or 1200. Now see where it is investment income. This is investment income from an associate. So we have to eliminate this investment income and replace this with share in profit of associate. Next adjustment, Gold Co. issued $100,000 100 par value 6% loan notes at par having interest payable annually in arrears over a 5-year term. The equivalent rates for non-convertible loan notes 8%, which is the effective rate. Gold Co. has recorded the loan note as a liability at par value and charged the annual 6% rate to finance cost. So it's a typical IFRS 9, IAS 32 adjustment. What we need to do? We need to identify the correct finance cost related to this. Already charged, we have charged already 6% interest. So interest charge in profit and loss account is 10,000 multiplied by 6%, it's 600. This is interest we have already charged. Now, in order to calculate it correctly, first we need to identify the liability component and the equity component. So let's do this. Let's do this. Convertible loan, split accounting. We have to identify the liability component first. So what is the liability component? It's present value of future cash flows. So that means we have year, we have cash flows, we have relevant discount factor, and we have present values. First one is the component of the liability is the 1 to 5, and we have interest first, and which is 600. And then in the year 5, principal amount, which is 10,000. Discount factor is 8%, which is effective. The rate has been given. Take these values. Annuity factor is 3.993. 3.993. And PV factor is 0.681. So this is 6810. This is 2396. This is the present value of the future cash flows. And this is my liabilities opening balance. Now, we have to apply amortized cost. So this is initial value 9206. Finance cost at the rate of 8%. It's 9206 multiplied by 8% is 736. Already we have deducted interest cost as an expense. So adjustment is additional finance cost. Is additional finance cost we need to adjust in profit and loss account. Next adjustment is no impairment of goodwill is there. Profit evenly accrued, right? So deferred consideration, unwinding of discount. So we have deferred consideration here. This is 31,678. 31,678. So unwinding of discount. How we can calculate this? We have present value, that is 31680. Discount rate is 10%. 9 months unwinding of discount, and this is 2376. Where I have to add this value? Add in finance cost. So all the working is done now. Let's compile this in consolidated profit and loss. Consolidated income statement. We have revenue, COGS. We have gross profit, admin, distribution, finance cost, share of associates, profit or loss, whatever it may be. And this is my PBT, tax value, profit for the year. And after this, I have to find out NCI share, profit attributable to parent company and profit attributable to NCI. Let's put the figures. The parent's company's revenue, subsidiaries revenue, but remember it's a mid-year acquisition, so it's 9 by 12. Intra-group sales, we have already calculated this. 9 months intra-group sales. So it's 143,560 consolidated revenue. Then we need to identify cost of goods sold. Parents' cost of goods sold 81920 plus subsidiaries cost of goods sold 9 by 12 minus 5,400. Unrealized profit 240. We have to add it back. And depreciation figure of fair value adjustment. Now see, fair value adjustment. We have fair value adjustment of plant. Let's see depreciation. 2600 divided by 3 into 9 by 12. So 650 is the depreciation. Add this depreciation in cost of goods sold. So it's 650. And now we have a cost of goods sold of 108,108,610 and GP is 34950. Now combine admin and distribution. So we have admin, that is 6080 parents admin and subsidiaries admin into 9 by 12. So it's 8885. Distribution, we have 2560. Again, the same principle into 9 by 12. And we have 4795. Now, finance cost. Finance cost given in the question is 672. Now, see finance cost. There is no finance cost given here. We have two adjustments. One is the interest additional we have to charge on convertible loan stock. Another one is unwinding of discount. So it's 3184. Share of profit of associate, we've already calculated 40% share. And this is profit before tax 19286. We have tax expense. Take 4480 plus 2560 into 9 by 12. It's 6,400 and profit is 12886. Now let's identify the final figure, and that is NCI. So let's put here NCI figure. So we need to find out profit after tax of subsidiary. It's given 9920, but we have to time apportion this due to mid-year acquisition. It's 7440. And this is there. So the depreciation on fair value adjustment. It will reduce the profit by 650. So net figure is 6790, and the NCI share is 10%, that is 679. So write 679 here. So from 12886, the balancing figure is parent's share of profit. And this is going to be 12207. So this is our complete income statement along with the goodwill calculation. So let's discuss another question. What is the requirement of the question? Prepare consolidated profit and loss and other comprehensive income, 15 marks, and then consolidated total assets figure, only 5 marks. Now let's see what is the acquisition detail. P acquire 80% share of S on 1st April 20x6 and it's March 20x8. So it's a full year acquisition. NCI is valued at fair value. Extracts have been given, profit and loss account, revenue, cost of sales, operating expenses, investment income. This is something we need to consider. We have profit for the year. We have total assets of both parent and subsidiary. We need to do some adjustments. Now see, adjustment number 1. So adjustment number 1 says that the cost of P's investment in S has been excluded from the total asset listed above. It's not included in 297310. As part of the consideration of S, 8 million is due to be paid on 1st April 20x8. P's recorded a liability of 7.547 in the individual statement of financial position, which correctly represent the liability at that date, at 31st March 20x7. No other entries have been made in relation to this consideration. P has cost of capital of 6%. So acquisition is on 1st April 20x6. Payment is to be made on 1st April 20x8, 8 million. So this is deferred consideration. And after 1 year, the liability reported is 7.547. So what we need to do against this? We have to find out the unwinding of discount at a rate of 6%. So first one is unwinding of discount. The discount factor is 6%. So we need to calculate unwinding of discount. So it's 7.547 into 6%, and that is 453. We have to add this 453 into finance cost. Next adjustment is, on acquisition, goodwill was correctly calculated. In the year to 31st March 2007, goodwill was impaired by 400,000. A further impairment of 300,000 is recognized in this current year. An impairment loss is to be charged to operating expense of 300,000 in this figure. At 1st April 20x6. Now, goodwill we have to show in consolidated balance sheet net of impairment. So goodwill is 3,200. 400 impaired last time, 300 impaired this time. So overall, goodwill is impaired by 700 out of it. Next adjustment. At 1st April, that is the date of acquisition, S property had a carrying amount of 11 million, but a fair value of 14 million. So we have fair value adjustment of 3 million. At this date, the property had remaining life of 15 years. ESCO sold the property for 15 million on 30th September 20x7. For the year ended March, S had recorded the historic cost depreciation and historic cost profit on disposal of property. Depreciation is charged on a pro rata basis. Now, this is somewhat a different adjustment here. First of all, we need to find out depreciation on fair value adjustment. From 1st April 20x6 to 30th September 20x7. It's April, May, June, July, August, September. So that means the total depreciation we need to find out, first of all. And if you can see here, our year started from 1st April 20x7. So April, May, June, July, August, September. So it's 6 months depreciation. So 3,000 divided by 15 years multiplied by 6 divided by 12, and depreciation is 100. Now, the profit has been recorded based on the historical cost. So that means the asset was in the original company's book, it was 11 million. So cost of was 11 million. Life was 15 years. And depreciation is of 18 months. So what is the depreciation total? It's of 18 months. So it's 11 million divided by 15, multiply by 1.5 for 18 months. So it's 1.1 million. That means we have to find out the carrying amount. Carrying amount was 11 million, but a fair value of 14 million. This was carrying amount. So carrying amount is now 11 million minus 1.1 million on the basis of the original historical cost, and disposal proceed is 15 million. So we have a profit on the basis of individual books. The profit is 5.1 million. Now we need to identify this from the perspective of the group, and the fair value was 14 million. Depreciation of 18 months, so 14 million, and it's depreciation of 18 months. So its remaining life is 15 into 1.5. So total depreciation we need to calculate divided by 15 into 1.5. It's 1.4 million. 1.4 million. So carrying amount after this is 1.4 million. So it's 12.6 million. And sale proceed is 15 million. So we have a gain of 2.4 million. So gain that we need to record is 2.4 million, and the gain already recorded is 5.1 million. So we need to adjust this 5.1 million and update this 2.4 million gain on disposal. Next adjustment is P made sales of 9 million to S during the year ended March. S had only paid 2 million of these goods. These sales were made a markup of 25%, and 1/3 is being held in the stock. So we need to adjust intra-group selling price as well as PURP. So what is PURP in this? So we need to find out unrealized profit, and it is in 1/3 of these goods. So 9 million into 1/3, that is 3,000 in stock. And markup is 25%. So it's 125 into 25. So the unrealized profit is 600 PURP that we need to add in cost of sales. At 31st March, the group decided to revalue its non-current asset. These assets were deemed to have increased by 4.1 million. This we need to add in OCI. These value in OCI, gain on revaluation, and S assets by 0.7 million. So this is OCI item. Neither company has recorded the revaluation in the individual financial statement. Ignore deferred tax. So this is very simple. You have to incorporate this in OCI. S paid a dividend of 1 million in the year, which has been correctly recorded by both companies. It means in the investment income, this reflects dividend received. So how much dividend we have received? 1 million multiplied by 80% by parent company, which is 800. So that means 800 is intra-group income. We need to deduct this 800, and 22 is my investment income. Tax is simply we have to combine. From this revenue, we have to adjust selling price. Here we have to adjust selling price plus PURP plus depreciation. And here we need to make impairment plus profit adjustment. So let's prepare consolidated P&L and statement of another comprehensive income. P&L and other comprehensive income. So we have revenue, cost of goods sold, gross profit. It's operating expense, profit from operation is investment income. We have finance cost, PBT. Then we have tax, and it's profit for the year. Then we have other comprehensive income, and we have revaluation surplus. And after this, we'll get total comprehensive income. And then a distribution of NCI in this. So let's compile the revenue. Parent's revenue is 58,200. Subsidiary is 34,300. The intra-group sales is 9,000. The intra-group sales is 9,000 given in adjustment. So it's 83,500. Cost of goods sold, parent is 34,340, 20,400 minus 9,000 plus unrealized profit. Now, as far as depreciation is concerned, let's see what would be the effect of depreciation. Depreciation we can either charge in cost of goods sold or in operating expenses. So it's a property. So let's charge in operating expenses. So COGS is final 46,340. This is COGS and this is my gross profit. Now operating expense, we need to work out operating expense. Suppose this is my operating expense working. And we have parents operating expense. We have subsidiaries operating expense. And then adjustments. Impairment will increase the operating expense by 300. Depreciation on fair value adjustment, 6 months depreciation. Now, the next thing is profit adjustment. So, profit on disposal. So, we need to remove the profit. Individual profit was 5,100. Remove this. And group profit was 2,400. Add this. It's an income. So deduct from operating expense. And we have 28,270 operating expenses. So profit from operation is 8,890. This is profit from operation. Investment income, we have already calculated investment income, 2,200. Finance cost, parents company's finance cost, subsidiaries finance cost. We have unwinding of discount. So total is 5,293. And this is my PBT. Tax expense combined together, 3,040. So profit for the year is 2,757. Revaluation surplus was 4,100 of parent company, 700 of subsidiary company is 4,800, and total comprehensive income is 7,557. Now, profit attributable to NCI and parent, and then TCI attributable to parent and TCI attributable to parent and NCI. So it's 7557. Now let's find out NCI figure. NCI. So this is profit for the year of subsidiary is 3690. Its depreciation, reduce depreciation 100, impairment, reduce impairment, profit is reduced by 300, profit on disposal adjustment, that is 5100 minus 2400. So it's 2700 of excess profit, and this is 590. This is 590. Take 20% of this 118. Add revaluation of subsidiary. Total after revaluation. Take 20% for NCI. It's 258. So this is NCI in profit 118 and 258. It's 118 and it's 258. So parent's share is 2693 and here parent's share is 7299. Next requirement is calculate the total assets that would be recognized in the consolidated SOFP. These are the total assets given, 297 and 110. So we have to combine total assets. First one is parent plus subsidiary, 297,310, and it's subsidiary. Then the additional assets, goodwill, 3,200, total impairment, 700. Then unrealized profit, it will reduce the inventory figure by 600. Then we have intra-group balances, 7,000. And we have revaluation surplus because it will increase the asset by 4,800. So this is the total assets to be shown in consolidated SOFP.